All right, the last part of price pattern behavior is candlestick behavior. And candlestick behavior is really kind of unique. It's really interesting because you can zero in on one moment in time. It's almost like looking at price pattern behavior under a microscope in a way. So I want you to remember when we talked about price movement is kind of like an accordion, where the musician can push or pull, and that will create force behind the pushing or the pulling. It's really similar to how these candlesticks behave. So for example, accelerating price movement can be seen in these tall, expanded range candles, or ERCs as we call them. And decelerating price movement can be seen in these short or narrow range candles, smaller candles in other words. So we call those NRCs, narrow range candles. So I'm going to give you an example. How does price actually move? Really, it moves in one of these two ways, where you have an expansion in price or a contraction in price. So an expansion or expanded range candle is what you see I've highlighted here. You have both red and blue. And so the expanded range candles, this is where you really have an acceleration of price movement going on. In other words, there's aggressive buying, that'd be the blue candle, or aggressive selling, that'd be the red candle. So these tall expanded range candles are the result of aggressive buying or aggressive selling. And it was triggered by any number of catalysts. Again, it could be economic report, earnings report, market open, and a big flood of buy or sell orders comes in, some news story, overbought, oversold. I mean, there's so many different potential catalysts of why price could go up or down, and it changes daily. And these ERCs, expanded range candles, can move price long distances very quickly, but they don't typically last very long in duration. So in other words, it's like a sprint where the sprinter can go really, really fast, but it's not going to last very long. The sprinter can only run at top speed for so long. And that's really what you see here. Yes, they can move very, very quickly and can go a long distance fast, but it won't be sustained. Okay, it takes it takes a tremendous amount of buy orders or sell orders to push price higher or lower for a long period of time. It's just not realistic. So when you see these ERCs, you can really expect it to be more in short bursts before it has to rest again. And that's where the narrow range candles come into play. So these narrow range candles are smaller candles, shorter. The bodies are shorter. The wicks are usually shorter as well, as far as from wick to wick. The range, as you can see on this picture here, is a very common example of a narrow range candle. And then so that's the small narrow range candles that have pent up energy that's just waiting to explode or expand, either up or down. Now this is important because when we trade, we want to buy or sell short as or just before the expansion in price, because that's how we maximize profit. So when we see these narrow range candles, that's telling us that, hey, be ready. There's going to be an explosion of price, an expansion of price sometime very soon. So this contraction that we see, or the narrowing of candles, is basically telling us, okay, price needs to rest for a little while. It needs another catalyst before it heads higher. And we want to be ready for that. And so a lot of our trading tactics are built around that, of finding these narrow range candles or waiting for the setup to happen and then anticipate these big expansion of price, either up or down, and then get in on that as it's happening, or maybe a little bit after the expansion has started to happen. And that way we can get that big price movement, which translates to profit potential for us. So again, all that needs is a catalyst to move fast. These NRCs often lead to very large moves in price movement. So we want to be ready for them and anticipate that happening. Let me show you some examples. All right, here we have a drop in price or downward movement. Okay, downward movement in momentum. We have two red candles, so price is going down and going down quickly, I might add. And then we see a pause in momentum. And this is what I was talking about. You really are going to see one or the other. The downward movement, the drop, the definite commitment behind the sellers, we see price dropping. Now, that's a sell-off, that's a commitment. It is definitely moving price lower. But again, it's only going to last for so long until it needs a rest. And that's really what you see here. A pause in momentum, or a rest from that big downward price drop. Now, oftentimes, just think, trader psychology here for a moment. Once you have a big sell-off, at some point, the people are going to say, it's gone down pretty far and pretty fast. I don't want to short now. I don't want to short after the move, so I'm not going to short. And then, you have the buyers out there, the people that are bullish are like, well, I'm not really sure I want to buy right now because this thing's coming down really fast. And so you have this indecisive type of attitude, or a decisiveness not to sell short, which causes a pause in that momentum. And so now traders are just sitting on their hands waiting for something to happen to get them to either buy or sell short. So let's say some time goes by and now the trader mindset starts thinking, it's not going any lower. It's been pausing for a while here. It's been going sideways for a while, so maybe it's not going lower. And when traders start thinking that, now they start to become a little bit more bullish. Because if it's not going lower, what's going to happen? Well, it's going to go higher then, isn't it? So now people start thinking, you know what? I bet it is going to go higher. I'm going to buy. And so they start buying, a little at a time, little here, little there, but then more and more people start buying and more people start buying. And the people that are short are now saying, starting to go up a little bit. I'd better get out of my short position. So when someone exits their short position, what is that? That's a buy order, isn't it? So that fuels the buying pressure even more. So now you have people that are not in position that want to get into a long position. That's bullish behavior. Then the people that are short want to get out of their short position, which they have to buy the shares back. And that's also bullish. So now this thing starts to rally like that. So now you have this upward momentum in price, or as we would say, just a rally. Okay, so we have a drop in price, then some form of a pause in momentum. Now it could be one candle. You could see several candles there. Usually they're narrow range candles for the most part. Sometimes they're not. They're just, bigger ranges, but very wicky. You got a lot of, a wick on the top, a wick on the bottom, and a lot of indecisiveness. That's fine. That's really communicating the changing of the guard, that pause in momentum, at least the pause in the downward momentum anyway. And then you get the rally after that. So this is a very, very common pattern, by the way, where you have a drop, a pause, or in this case, a reversal in momentum, and then that upward price movement. You will see this on the charts all over the place. It's extremely common. Here's another example here. Same downward movement in price. Now we get that pause in momentum, but this time we see another drop in price after the pause. And this happens too. You actually see this fairly often, where that downward force, that downward selling pressure, the selling force is so strong that even after a brief pause right here, there's more selling pressure coming along the way, and it just pushes it down even further. So this is another very common pattern that you'll see. All right, next one, we have a rally in price. Then we see a longer, more drawn out sideways momentum. And that's just that, again, indecisiveness where people are not committed to buying, but they're not committed to selling either. So it's just this back and forth. Some people buying a little bit, some people selling a little bit, but there's no definite, dominant, aggressive buying or selling behavior. So this is more passive buying and selling behavior. This just might be people selling a long position, taking some profit, or, just some more passive type of trading activity, until at some point comes along a catalyst, which pushes price up higher or lower, higher in this case. And so now we get the momentum going again. So now we have, in this particular pattern, a rally, that's the upward momentum. Then it goes sideways, that's that pause in momentum, that indecisiveness, and then price rallies up higher. So also another common pattern that you'll see out there. All right, let's summarize. So price moves in three directions: up or upward, that's the rally; a downward move in price, so price is going down or it's dropping; and then sideways, which again is just your pause in momentum. And price movement is caused by at least one catalyst or some kind of outside force. Oftentimes it's more than one catalyst, by the way. That does happen. But it's going to be at least one catalyst pushing price up or down. And then the acceleration of momentum is seen in expanded range candles, and deceleration of momentum is seen in narrow range candles. All right, ladies and gentlemen, go ahead and continue on to your next lesson.